terms of sectors, I'm looking at like cyclicals. I think there's enormous value in Europe. I think everybody has been loving to hate Europe for the past 20 years. And as a result, you've got, I think there's amazing value there. And also because of what we were talking about earlier, which is the fact that like equities in Europe are massively under-owned. So like, if you think, basically the average saver is like 20% of equities, which in my opinion makes absolutely no sense. At the minimum, you should be headed to like 30, 40%, which is more like what you're seeing in the US. And I think that's part of the reason for value there. Obviously, the other reason is that it's a sector that was heavily weighted towards financials, insurance, all those sectors that are like super sensitive to like steeper curves. So e.g. they're doing really badly with like flat curves or like inverted curve. So I believe very strongly that curves should be much steeper than we are right now. In fact, like you don't need to look at crypto. I mean, if you were just short bonds for the last 5 months, like I've been recommended, that's like a really strong trend and trade that you can probably leverage up as much as you want to get some similar returns as like Bitcoin. Just joke apart. That's a very, very strong belief of mine that like European and US curves are just way too flat. I mean, it makes absolutely no sense for the US to be able to print like 5 trillion, 10 trillion, and basically like finance it at like minus. We're still like in the 10-year real rates are like minus 90 basis point. And like it makes absolutely no sense. So one of my very strong belief is that today's super easy monetary conditions are basically the path to much higher rates, and the reason. And the fact that we have very low rates today, very low real rates, should mean that we actually can get much higher rates later in the cycle, which means that the curves are way too flat where we are, which means that basically financials, insurance should be doing much better. Obviously, Europe is heavily weighted towards those sectors, and obviously like industrials. I mean, we're really like going into macro revolution, which is basically favoring those sort of sectors that basically had been stagnating. I mean, if you actually take out tech in the US, and if you don't look at the US, European stocks have basically been stagnating for the last 20 years, and have only just broken out of like a 20 years triangle, just like I think it was last month, right? So yeah. The upside is just enormous. And
Japan probably falls in that category too, having broken out maybe earlier in the year, later last year. Sorry.
So it's just those trades that like everybody were like calling the widow makers, like selling JGBs, buying European stocks, selling bonds. For me, it's like basically the trades that everybody still look at you and they're like, what? I've lost so much money doing those trades, but I've never recommended them before. It's only like started last year. So it's all down to like the ongoing macro revolution. And again, I want to repeat it. It's just what's really mind blowing is just such a massive move that it will not get priced in a few months. And that's why we're basically like keeping chasing price action and like every month I'm basically like looking into all my themes and making sure that it still makes sense and that I should keep chasing, because it's really important at every level to really make sure like you still want to belong after that 80% move, and it's every year is basically made out of not having the right trade, but actually having the conviction to actually push that trade and to not like, look at 10% and be like, I'm okay with that.